I thought jargon for law was hard. Jargon for finance is harder. Well, not really. Law jargon is way harder because then you start speaking Latin and all kind of stuff. But I suggest before I learn law, I learn business. So here I am in my introduction to, well, I'm in accounting class, but I'm in the introduction to financial accounting, and I'm watching video after video, taking note after note after note. And I tell you, these pages, they fill up quick, okay? Well, this one I gotta go back to here because this is lecture 2, which is on the iPad. But that's besides the point. I've literally been in class for about a week. And this is a good chunk of like the beginning of my classes. It's this much pages of notes since the beginning of class. And honestly, this much, I don't know if it's because the book is small, but there's so much information on these pages. Not that one, but there's so much information on these pages that I have to sit here and teach myself the jargons of, and this one is data analysis, of these words. You know, I actually like data analysis. We have a little study buddy that's AI that helps us understand our work and explains it to us in our own words. So I like that aspect of data analysis. And accounting, it's like I gotta break down the jargon. But once you break down the jargon, you realize it's never really about numbers. The numbers is just there, it comes easily. But first, you gotta understand the terminology. So that's what I'm doing, watching YouTube video, taking notes. I already started, but I'm watching an 18-minute one now, so I decided to continue. And then after this 18-minute one, then I have to go into the second part of this lecture. So hopefully, hearing this clarified here, I can a complete financial accounting course, full 11 hours. Sorry. Now, why would you? This is Tony Bell. Not that. Hopefully, you know, the way it sounds straightforward. So let's just see what that's like. And I'm going to only take the notes from Understanding Professor Nana Amora's class so I can get it down to a science. Because he has good information. It's just I need the jargon to be like, he's defining them, but he's defining them and I'm listening and then I'm learning. But I'm a visual learner, so I would need to see the definition of these words on the board. But I have to pause, replay, go back, I don't know. I'm not a visual learner, more so to speak. I'm hands-on and, well, at least different things, it switches. So for data analysis, I need to be hands-on, but I need to watch and do. But I can't watch and do at the same time. I would have to watch first and then I would have to do. But when I do, it better look the exact same as what I watched, or else there's going to be some problems. As far as financial accounting, yes, I'm hearing and I can hear, which is good. But I just need to try different things because it's going to take some time. And once I invest this time, as Dr. Amora said, I should be good. So that's what I'm going to do. And pray for me, please. Hallelujah. Philippians 4:13 over my life. Right now. Let's go.
Prayer to survive your accounting class. You're going to need to understand these 6 words.
Did he just say prayer?
Accounting class. You're going to need that business. And if you want to have a prayer to survive your accounting class, you're going to need to understand these 6 words to survive your accounting class. You're going to
literally a prayer.
Understand these 6 words that we're going to use in this video. So let's.
And I was suggested to take my favorite drink, and one of my favorite drinks are wine. Only if you're 21 or over, you can take up some wine while you're doing some deep studying. Only if you're 21 or older. If not, get off of this live. It's not for you. You may start spilling some things out of my mouth that you don't or you shouldn't be hearing, at least from me. We're not quitters. We don't give up. We keep going. We're dedicated. And we read reread and we reread and we revise the lines. So that's what I've been doing. And if you might see me press play and pause and scrub in here and there in the video, but that's just so I can understand. If I feel like I need to take notes, then I'll take notes. Okay.
This video,
From this one, I'm taking notes on this one, which is my professor. This is secondary resource, who happen to have 11 hours of tutoring. If so to speak, if I needed to do that, I would. But I think I'll be good for now.
Over 10 minutes, and all we're going to do is talk about these 6 words, but you need to have them super internalized. You need to be an expert on understanding what these words mean and how they make sense.
I might take notes on his as well.
Oh, I'm accounting, so let's get to them. Here are the 6 words: assets, liabilities,
I know.
shareholders' equity. I guess that's 2 words I counted as 1. Shareholders' equity, revenues, expenses, and dividends. And the 3 that are in color there are really going to be key to your life.
So total assets equals total liabilities plus shareholders' equity. Boom! Accounting equation. I learned something.
Well, they'll all be key, but those 3 particularly will be. So let's begin by talking about assets. And when I begin a course, I begin talking about assets, and I ask my students, hey, make a list of all the assets you think a typical undergrad student at this university will have. Make a list of typical assets of an undergrad. And so here's the things that they list out.
Computer.
They list out things like cell phone.
Mm-hmm.
We have got to the point where literally anybody can build a fully working app without knowing how to code. This
Not
is
an
based for
ad in my freaking YouTube video live.
They might say,
Some have a card.
Textbook. They're looking around the classroom.
Yeah.
Textbooks. That's a typical asset of an undergrad. Maybe a car.
Maybe they're the ones.
That's the list generated by students. But I also get some more interesting or creative answers. Some might say they have beauty.
I was about to say for black people, wigs.
Or even something like a
Some white
high
people wear that.
school diploma, because of course you're an undergrad student at a university, you probably have a high school diploma. So these are all, I think, good examples of assets of an undergrad. Now the first 3 on my list are much simpler to discuss than the second 3, but we'll discuss both here. The thing that all of these things on the list have in common though, and this is how I want you to think about assets, they're anything of value. The word I want you to think of is they are things of value. So that word should just be really tied to assets. The technical definition gets a little bit more complicated. I don't ask my students to give a technical definition, but your prof might. If they ask for a technical definition, it's anything that a company owns or controls created from a past transaction that gives us a future economic benefit.
This pen is running out of ink. No, it's not. Oh, yeah, there's definitely something wrong. Why did I start pulling? See, like, me watching the live back, I could see what I be doing while I'm learning. Like, why am I digging in a pen? This is not something I'm supposed to be doing. Taking it apart and stuff. easily distracted. I noticed that. And this is not typically normal. This is not something that should be going on during learning practices or in a classroom. But this is things that I do. Lord help me. I only did that because it started to mess up, but I guess I should switch to a pencil. If it happens again, that's what I'm gonna do.
That's
It's gonna
a
happen
pretty
again.
technical definition.
Insanity is for me to
Anything
keep
you
using.
own, or you can typically think of it as owned in intro financial accounting, but then leased assets also can count under this category, but most of the time it's just owned. Stuff you own, that's good to own. 99% of the time, that's a sufficient understanding of what an asset is. Now, let's think about this list. So cell phones, textbooks, cars, those are all things of value, and absolutely these types of assets find their way onto company financial statements. When the company is listing its assets, it would list any cell phones the company has, any textbooks, or any cars the company has. Those would all fit very easily under the definition of asset. The last three, however, absolutely would not find their way onto a company's balance sheet, even though I think they're assets. I think they are things of value, right? Your high school diploma is certainly something valuable to you. It's useful for the rest of your life. It makes you more employable than not having a high school diploma. Your youth, your health, these types of things absolutely are very valuable and should not be taken for granted.
As we all know, one of the most important parts of the writing process is to cite sources that support our claim.
But why don't you find their way onto financial statements? And there's a simple reason. And the reason is, it's hard to put a number on it. It's hard to say how much they're worth, right? I have a CPA designation that allows me
How much
to
is my
teach at
beauty
this
worth?
University. Well,
Unlimited.
my CPA designation is definitely my most valuable sort of academic
You know that
achievement. But how many dollars is it worth?
Infinity.
Is it worth $1,000? Is it worth $10,000?
Academic
$100,000?
achievement.
$1 million? It's
But
really
then
hard
the question of
to
ROI
quantify
comes into play.
how much that's worth. Now my
How
car,
much is a
I
diploma
can put a
from
number on
your
it and be
expensive
pretty close.
university?
My cell phone, I have an iPhone 8. I can look up online. What's an iPhone 8 cell phone? right?
Beauty.
That
Some
I can
people
put
could
a
say the
number on.
beauty standards of models.
My-
That's where you
my
can
beauty?
I guess,
What's my beauty?
value that.
Not much, I would guess, but who knows, right?
I don't
What's
know
the
about
number
his.
you would put on somebody's beauty?
No
Very
offense.
difficult to measure. And so companies say, look, that
But,
stuff,
you know,
yes, we
even
agree,
models,
there
like,
may
they have
be
more
value
value
there.
than just
We're
their
not gonna
beauty.
try to put a number.
Which is why one gets paid more
Stuff
than
like
the
cell
other.
phones, textbooks, and cars, absolutely, yes, we will.
I think
So,
an asset would be a
anything
position
the
on a
company can
court.
own or control that has value, that's good to own or control, that can be
Or
reliably
maybe something else. Let me
measured.
not. I'm just
That's
focused
sort
on
of
this.
a-
That's from data
of
analysis.
what makes an asset
Like,
an asset. So what are typical
Need to
assets
close
that we
in my
find
bag.
on a company's an asset that can be reliably measured? That's
Okay,
sort of
reliably measured is an
what
asset.
makes an asset. So what are
Value
typical
that's
assets that we
reliably
find on a company's financial statements, on their balance sheet? Well, we could find something like cash. Of course, that's something you should want to own and own more of. There's something called account receivable. And what accounts receivable are when somebody owes you money. So you're gonna collect money in the future, a future economic benefit. I use that word. Well, we're collecting money in the future. That's a future economic benefit. So that is absolutely something that would be categorized as an asset. Easy for me to say. Inventory. If you walk into a Walmart or a retail store near you, look around, right? All the stuff you see that they bought from their suppliers that they're planning to sell to you, the customer, that is inventory. And that is assets, right? That's stuff they own. That's good for them to own. We have a broad category, which I'll call property, plant, and equipment.
What is
And,
plant? I heard that before.
you know, it almost seems overly technical here. Property is land, like literally land, real estate, property. Plant is buildings, plant. It's such an outdated term, but you do see it used all the time. It's buildings. So you can own a building, right? That's something of value. And equipment, all this stuff.
I literally did not know plant wasn't equipment, like a plantation? Huh? Huh, America? Huh? Please, don't go back. Just stay. Please, just play. Just play. Just play. Come on.
Computer equipment, or you might have
I'm at 718.
Inventory, equipment, all this stuff. Computer equipment, you might have machines, value, and equipment, all this stuff. Computer equipment, or you might have machines, these types of
I really just want to use this blue pen because
it's a broad.
I don't have to highlight my
Now the
pencil.
list
It
here, I can
smudges.
take a long one.
I literally don't want to use the pencil because it smudges when I highlight it. But at the end of the day, it's still legible, so let me just shut up and stop whining and use the pencil. This pen's not working. And I think it's good with categorization.
Things like investments, right? Like Facebook bought Instagram. Well, they spent $1 billion buying Instagram. That is an investment. Instagram is an asset that belongs to Facebook. And our list could go on and on. But these are typical assets you find on company financial statements. Moving over, and actually before I move over, just to reiterate, when you think asset, I want you to think something of value that a company can own or control. Okay, something of value that a company owns or controls, and the value can be reasonably reliably measured. Looking at liabilities, if my keyword for asset was value, my keyword for liability is even simpler. It's owe.
Oh.
Liabilities are anything that has to be repaid in the future. So
My apartment is a
from student
liability.
perspective, you might have student loans. Those are liabilities. They're things you're going to have to pay back. If you have a phone bill sitting on your table and you haven't paid it yet, great example of a liability. I have a mortgage on my house. There's a liability. And companies can have very similar types of obligations, right? They have similar things they have to pay back, and these are the liabilities of a company. So anything a company owes, and I think to give a technical definition, we would say any future economic obligation, meaning anything they have to pay back in the future. So examples on a balance sheet, well, we said for assets there's accounts receivable. For liabilities there's something called accounts payable. Is a very common liability that you'll see on a balance sheet, and it just means typically within 30 days you've got to pay it back. And so I always think of a phone bill. When you think account payable, just think of phone bills and bills like that, and you're not far off.
Students with ADHD save 10 hours studying with this Chrome extension. But no, by all means, go ahead, skip the ad, save a few seconds.
I have to do a lot of reading for my job, emails, reports, write-ups, but sometimes reading can get really, really tiring. To stay focused, I use a free Chrome extension called Speechify. All I do is highlight the text, right-click, and then Speechify reads it out to me.
SEC data show $359 million of GameStop shares failed
I
today.
can increase the speed and can pick from a variety of really high-quality voices, which just makes it so much easier to focus.
The only reason I have this unidentifiable ADHD is because y'all show me mother fucking ads in between my freaking YouTube videos.
Well, all sorts of, we'll call them, there's a broad category here called notes payable. And, within that category is things like bank loans, student loans, mortgages. The category is called note payable. And note payable is just a piece of paper, contract you sign saying, I promise to pay you back on this date with this much interest, right? That's a note payable. And so that a bank loan fits that, a mortgage fits that, an informal, they call it a promissory note, fits that. All sorts of things fit that category. But those are typical liabilities. We can have all sorts of other ones. We can have wages payable to our employees, bonuses payable, things like this. There's no shortage of items I could put on my list, but we'll cut it off there. So when I talk to my students about these categories, people generally have a pretty good idea about assets and about liabilities. Where things get a little bit shakier is when I ask about shareholders' equity. Not very many people have a good definition of shareholders' equity, and largely because it's defined by what it's not. And I'm going to explain shareholders' equity actually by explaining my house. I own a little house, and it is a house that costs $300,000. So there's this asset, right? And it's this house, and it's a $300,000 house. Now, as I already suggested to you, when I bought the house, I did not have $300,000, so I took out a mortgage. And if I look at that mortgage statement today, it's around at $200,000.
My question is, can your asset also be a liability? Well, yeah, assets equals liability plus shareholder equity, so it's eventually some of that.
Mortgage. And a mortgage, of course, we said is a liability. So I have a liability of $200,000.
Then the
house against which there's a $200,000 debt or $200,000 liability.
Mm-hmm.
If, and this is where equity comes in, if I were to sell my house today and I were to liquidate it and I got $300,000 cash, I pay off all the debts against it. So I pay off the mortgage. How much money goes in my pocket? Well, the answer is $100,000, right? I have a $300,000 house. I liquidate it. I get $300,000 cash. The mortgage company isn't going to allow me to keep the mortgage if they don't have the security of the house. So they take their $200,000 back. $300,000 proceeds on the sale. $200,000 goes to the mortgage company. $100,000 goes to me. My piece of the pie, my piece of the house, the shareholders' piece of the company is called their equity. Equity is the concept of what's left over. If I sold off all the assets, I paid off all the debts, what goes in the shareholders' pockets? That is their equity.
So then if you look at it from a balance sheet perspective, the L and the SE equals the A. So both sides have to balance out. So the asset is $300,000, the liabilities and the shareholders' equity both total to $300,000, which equals the assets, if I'm correct.
For my home, we would call it home equity. For a company, I've abbreviated here as SE, and SE stands for shareholders' equity. And so my shareholders' equity is $100,000. This relationship creates something, and you'll learn about it in chapter 1 of any accounting book in the world, this thing called the accounting equation. Assets equals liabilities plus shareholders' equity. A equals L plus SE. So 300,000 equals 200 plus 100,000. Okay, so when I think about equity, I actually think of this formula. I just think A equals L plus SE, or alternatively, shareholders' equity is what's left over when I take my assets and I subtract my liabilities, right?
Yeah.
That's what I think of when I think of equity. So there's not a sort of fancy one-worder. I guess if I were trying to put it into words, I would say, what's the owner's piece of the pie, right? They pay off all their debts. How much money is going into the owner's pocket? That's what I think of when I think of equity. What are the accounts? Well, one is called common shares. So if you buy into a company, you buy shares, you're buying equity of the company, right? You're putting in thousands of dollars, they're giving you shares, you're buying a piece of the pie, so it's called common shares. There's also preferred shares. If you're taking an intro class, you might see this referred to as share capital. That's a common thing you'll see. And a big important account is called retained earnings. And we'll get into this more as our see this referred to as share the dollar earned to the owner's pocket. That's what I think of when I think of equity. What are the accounts? Well, one is called common shares. So if you buy into a company, you buy shares, you're buying equity of the company, right? You're putting in thousands of dollars, they're giving you shares, you're buying a piece of the pie, so it's called common shares. There's also preferred shares. If you're taking an intro class, you might see this referred to as share capital. That's a common thing you'll see. And a big important account is called retained earnings. And we'll get into this more as our videos go on. Here's the gist of retained earnings, though. You invest or buy into a company, you run a company to make profits, right? You want to make money, right? You want to earn money. If your company is profitable and making money, you have two choices with what you can do with the money. You can keep it in the company, retain those profits, in which case the amount goes into retained earnings and the shareholders' piece of the pie gets bigger. Or you can take it out of the company and you can pay yourself a dividend, in which case the retained earnings gets smaller, the shareholders' equity gets smaller. So it might seem a little complicated right now. Just know that there's retained earnings is an account that keeps track of how much profit is being kept in the company versus, and again, the alternative is pay it out as a dividend. So that is what retained earnings is. So we've got these three key accounts. Assets, the stuff we own and control that's good to own or control. The things of value, liabilities, that's what's owed. Shareholders' equity, that's the shareholders or the owner's piece of the pie, what's left over. If I take all my assets, sell them off, pay off all my debts, what goes into my pocket? That is my equity in the company. Very quickly, revenues, expenses, and dividends. I'll be much quicker here. Revenues, the word I want you to think with revenues is
Money?
earn.
Oh,
Oops,
earn.
not earn. Revenues are what happens when the company does what it does to earn money. Walmart sells me stuff, they have sales revenue. My university charges tuition, they have tuition revenue. My landlord, well, I own my own house, but if you were a landlord and you charge rent, you would have rent revenue, right? It's the business doing what it does to earn money. Think of revenues as being earned. How is the money coming in? It's the revenue generating part of the business. Expenses, think of costs. So again, thinking of a university, I love my job at the university, but I don't do it as a volunteer. I don't do it for free. They got to pay my salary. They have a salary cost, a salary expense. They also have to pay to keep the lights on. Well, that's a utilities expense. They also have to pay to keep the carpets clean and the place maintained. That's a maintenance expense. There's all sorts of costs of running a university, and those are the expenses. Those are the costs. Dividends, as discussed earlier, are at the end of the year, if the company's revenues exceed the expenses, in other words, if we earn more than we spend, we are profitable. And if we're profitable, we have a choice to make. We can keep the money, keep those profits in the company, or the shareholders can say, I'd like some of that money. I'm going to take a dividend, and they'll pull their money out of the company. So dividends are shareholders pulling profits from the company, taking it from the company's retained earnings. I used to think that was a problem. I used to think that there's something wrong with that. I no longer think that. I think, look, if your company's profitable and you would like to use the money for something else, you should be able to, and that's called a dividend. Okay, so these 6 terms should be ingrained in your brain right now. And going forward through the course, you need to understand these 6 terms. Asset, things of value, things the company can own or control that are good to own or control. Liabilities, that is owed, that is a company's obligation. They've got to pay something back in the future. Shareholders' equity, if I take all the assets, I sell off of the line, I sell them all off for cash, and I pay off all my debts, how much money goes into the shareholder's pocket? What's the shareholder's piece of the pie? That is their equity. Revenues are the company doing what it does to earn money. Expenses are the costs of earning that money. And dividends are when the shareholder wants to pull money from the company, they want to withdraw money from the company, they take a dividend. All right, with those 6 words in mind, you are ready to take on the rest of Chapter 1, Module 1. Good luck. I'm thrilled that you're with me on this journey to better understand accounting. All right, bye for now, everybody.
I ain't gonna lie, that wasn't as brutal as it could have been. Yeah. Okay. It was beginner basics. How many beginner basics he has? Is this because this is like, 6 years ago? And then this is a 17-minute one. Did he just update it? Like,
Go to a website you love.
he just made a new video?
With Wix. For your words, create your...
Welcome to our class in fight. And these ones are not represented in...
He's just teaching the same thing again, but more updated and modern, but it's the same thing. And of course, nothing's better than the original. The 6 years ago one has
Hello and
more
welcome to our
life.
video series on financial accounting. And welcome to
Which is
Module
cool.
1. In
So
this-
I see he just basically replenished it. So I don't have to watch the same exact thing.
Hello and
If I wanted it, this one has 23K likes. If I wanted it in another way, then I could. But I don't need that same exact video. Since the overload shall soon approach. Because not only am I watching him, I'm watching my other professors. So I'm going to finish my professor's videos. And then once I finish my professor's videos, I'm then going to go into his 11-hour full account.
welcome to our class.
Thank you. And then there's one, how to learn any skill so fast it feels illegal. Justin Song. Yeah, you are learning too slowly. Thanks for letting me know that. I was learning too slowly. Adjusting into cash, receivables, inventory, cost of inventory, property and plant, liabilities, and modular equity statements of ratios. And I feel like I learned all of this within one day. Like we're literally in class doing ratios right now. Talk about complete financial accounting course. So basically, what I feel that I understand is that we're accelerating learning this material at a very accelerated pace. It's not like, why am I in the dark, for one? Why am I in the dark? And the Lord said, let there be light. It's not like undergrad, you learn the introduction of the vocabulary words, and then after that you're done. No, you're doing problems and dividends and equations same day. Yeah, so that's why I was mind like boggled. I was like, yeah, what? But I'm not gonna watch this 11-hour video. There's a 5 thing one. I do want to watch You're Learning Too Slowly.
I've been obsessed with
And I watch him after. You need to stay focused. Introduction to Financial Statements Lecture, Part 2. So I don't know if I should finish Income Statements Lecture, Part 2. And then I'm going to watch Intro to Financial Statements, Part 2. Because I already watched the other Intro to Financial Statements, the first part. And they said financial statements, I thought they meant like financial vocabulary. And that's not the case. So now we're on to ratios, and we're soon to learn effects of transactions. Dang, we learning so fast. Golly.
Revenues based on the proportion.
Video unavailable. Oh my. Ad. Go ahead. You're itching to play one.
If you are the owner or manager of a building with a flat top roof, then please pay close attention.
And 60% by dividing the per each year during the 2-year period for this project. So for 2011, we will recognize revenues based on the proportion of costs incurred in 2011 compared to the total cost. So we first start off with the percentage of the contracts completed as at end of 2011.
Percentage.
And that is determined by dividing 1.5 million and 3,750,000, and we get 40%. So we estimate 40% completion. So we recognize 40% of the total revenues, 5 million. So 40% of 5 million is 2 million. So we can recognize 2 million revenues in 2011. Now, for 2012, we see that 2,250,000 was the cost incurred. So the percentage of work done in 2012 is 2,250,000 divided by the total cost of the project, 3,750,000. So when we divide, we get 60%. And 60% of total revenues is 3 million. Let's now discuss some of the risks of revenue recognition. Some of the risks, 2012 is 2,250,000 divided by the total cost of the project, 3,750,000. So when we divide, we get 60%. And 60% of total revenues is 3 million. Let's now discuss some of the risks of revenue recognition. We first look at the percentage of completion method and the risks associated with revenue recognition under this method. Now, based on the long-term construction contract example we just reviewed, a company could overstate revenues, inflate revenues up, if it uses a lower estimated total cost of the project in a period. This is because a lower total cost implies a smaller number in the denominator, which will be used in the calculation of the percentage of completion. Now, using a smaller denominator increases the percentage of completion, which in turn will yield higher revenues. Note that a similar risk may apply to service outsourcing and rental contracts, as revenue may be recognized for such contracts using the percentage of completion method. Let's now look at gross versus net sales, or gross versus net revenues. What are the risks associated with that? Now, the risk is that companies may record commission sales at the gross amount rather than the net commission that represents the true earnings for the agent when the agent sells the inventory. Now, grossing up the sales would obviously inflate profits reported for that agent company or dealer company. Let's now turn our attention to sales on consignment. In sales on consignment, a company earns revenue as an agent for the seller. It does not take title or ownership of the inventory, and as a result, it cannot characterize the gross revenues or sales.
Like Amazon when they sell people's products.
What it rather should do is disclose the consignment arrangement and identify its revenues as commissions rather than sales. Thus, one potential problem could arise if the company records these commissions before the sale is actually made to the final buyer.
I thought I knew something. I was so wrong. Amazon do not operate on consignment model the way boutiques or consignment shops do. Buys products wholesale from brand distributors and will sell them to customers. Oh, in this case, Amazon takes ownership of the inventory. Marketplace sellers, independent sellers list their products on Amazon, their own inventory until it sells out, and Amazon earns fees, commissions. That's what I was talking about. For most sellers, no, Amazon does not take products on consignment. Sellers are responsible for their own inventory costs and Oh yeah, until the item sells out. However, in rare cases, large brands and vendors may negotiate vendor flex or vendor consignment agreements with Amazon. In these arrangements, Amazon may stock inventory in its warehouses without paying until the items are sold, but this is not available to regular small sellers. Fulfillment by Amazon FBA. You ship products to Amazon warehouse, but you still own the goods until they're sold. Amazon handles storage, shipping, and returns. Drop shipping allows under strict rules, but you must remain the seller of record. Merch by Amazon, print on demand, closer to consignment. And Spirit, since you only get paid when something sells, but it's digital manufacturing, not physical inventory storage. Amazon doesn't run the consignment shops for everyday sellers. You must either sell wholesale to Amazon or keep ownership of inventory until it sells, until only a very large vendor sometimes secures consignment style contracts with Amazon. Okay, so now they're trying to put Meraki Way into it. Meraki Way needs to learn this.
Let's also discuss risks related to multiple element sales contracts. Now, a multiple element sales contract is a sales agreement that bundles goods and services that may or may not be delivered simultaneously. Let's consider an example. Let's say Amazon considers the Kindle as a multiple element contract because the hardware is a separate deliverable from the wireless access and the promise of future upgrades to the operating system. Now, because a multiple element contract involves deliverables which are separate, what Amazon should do in such a situation is recognize revenues on each element at the time revenue is earned for that element. However, what we tend to see is that in some cases, companies recognize all the revenues up front for all the elements of the contract. Non-refundable fees. Now, that could also pose some risks. Now, when a company collects non-refundable fees for future goods to be delivered or services to be performed in the future, it is important to emphasize that revenues have not been earned. Until the company earns the revenue, the amount received is actually a liability, as it represents a future performance obligation for the company. If the company expects to earn the revenue in the coming year, the amount received is a current liability. Otherwise, it is a long-term liability. Let's consider some examples. Customer deposits. Now, this is a collection upfront for goods or services to be provided by the company in the future. Another example, gift cards, season tickets, non-refundable membership fees paid upfront, layaway plans of retailers.
Wash my hair, my wig. Sales or
Let's now consider the last item, which is sales with right of return. Now, we know that many companies offer the right of return with sales. Now, companies that offer a right of return with sales can only recognize sales if the estimated returns can be determined. Now, estimating the returns will be matching the cost associated with the sales, and this time it's a contra account, but it's a cost. You can consider that as a cost. That is, items that returned should be subtracted from the total sales. So companies that offer a right of return with sales can only recognize sales if the estimated returns can be determined. Again, note that the
At the
estimated
same value that
returns
you bought the item, unless it's like a camera lens, like I just
the
purchased.
gross sales.
It has a
If the
15% deduction from the amount that I paid. If in the case that I want to return that camera lens for the Sony ZV-E10, I got the E11 f1.8, and my regular E10 is about, I would say, my regular E10 is about $16 mm, so I wanted something a little further away. So I got 11, which is much wider, but it was much more expensive, in 600 range. I had certificates from Best Buy, but I didn't use them because I didn't want to pay interest. So yeah. So now I must use that camera when it comes back after it's done being fixed with my $1 million lens, and create top tier content for you all. Hopefully you stay and join me on my journey. I actually want to do a review to a really old video that I made, and it's gonna be a quick little like discussion rant type of thing. Probably gonna have my camera over there. It's gonna be a nice crisp and clear angle. Like, yeah, I'm gonna have my video in picture and video in video, not picture in video. It's gonna be a video in video, and I'll be talking like a Mahogany Love reaction to Meraki Love's reaction to Mahogany Love. What was it, year 2022? Post-COVID self-actualization, realization stage of life. 2025 reaction. I'll put. And I'll add on to the video since it cuts off in the video. Disclaimer, spoiler alert, it cuts off in the video, and I'll talk about where I'm at today and how I got there and what I plan on doing moving forward. And nothing too much. It's all really God. I can say what I want to do, but God has the final call. So now we're ending up this video.
Company cannot estimate the returns, then it must delay revenue recognition until the end of the returns period. Now, this ends our discussion of the income statement.
Imagine being able to build anything just by thinking about it.
Cash
Base
versus
44, a complete AI creation.
Today we're going to cover another topic that's often a reason.
This is another lady.
Cash.
Because we spoke about accrual accounting in class, and I think just watching it from this other perspective of another professor might help me understand. And after I listened to her. This is Leela. Or Lilia. Sounds like I'll learn something good from her. Then I'll go to Introduction to Financial Statements Lecture 2, which is what I was on before I went into my tangent of watching the other guy and this girl. But you know, I learn a lot with stories and whatnot. So I gotta put the time in if I want to learn.
And accrual accounting. Two very different accounting methods. In this video, we're going to take a look at both and see how each one could affect a business in different ways. We'll also see why income and cash can be two very different things. Lots to cover. Let's get started.
Fun fact, I got 312 subscribers on YouTube. Thank you very much.
That's often a reason for confusion. Cash and accrual accounting.
When I hit 1K, I will have such a celebration because I've been working very hard. Even though there's not a lot of people on the live channel, that's okay. You know why? Because that's okay. Eventually, I want to change it to like Meraki Love Live if I go really like up in streaming and I get into Twitch and all kind of great things like that. But right now, I just have to be patient. I'm at 310. I was just at a very stagnant 250, 252, and now I'm at 310 and counting. So I love y'all so much. And it makes me feel good. As you've seen, I was just creating what the visual would look like in my head and just all this financial accounting terms that I'm applying to my video and content creation. Like, oh, that's my accrual expenses. It's not yet paid, but it will be due to y'all. I'm in debt to y'all, my videos. I owe y'all these videos for a long time. Accrual. So let me just learn, make sure I'm learning effectively. Maybe y'all can hear and learn too. Might be copyrighted from this young lady. I subscribe to her. But yeah, I'm done talking now.
Two very different accounting methods. In this video, we're going to take a look at both and see how each one could affect a business in different ways. We'll also see why income and cash can be two very different things. Lots to cover. Let's get started.
That's a good question.
The difference between these two concepts is in the timing of when revenue and expenses are recorded in your accounts. So just to be clear, over time, both systems will get to the same results. But at a certain point in time...
Disclaimer, I'm in the middle of my Dreams and Schemes book. Some things are changing. I've always said, when I finish this book, some things are going to be different in my life. Things are already getting different. So...
may be differences. And that's something that's important to understand, especially when it comes to analysis of financial statements. Let's start with the easier part, cash accounting. Cash-based accounting is a very intuitive system. It recognizes transactions only when cash is actually exchanged. So revenue is reported on the income statement only when cash is received, and expenses are only recorded when cash leaves your account. So under this method, it doesn't matter in which month you did the work for your client or you sent an invoice to your customer. The only thing that matters is when they actually paid you. Same thing for expenses. Even when you purchase all kinds of stuff on credit for your business, it won't show in your income statement until you pay for it. So this can be your accounting method of choice because, well, one, it's intuitive and it's simple to understand. Two is that as a business owner, cash is the most important topic to be on top of, and cash accounting helps you do that. Number 3, you might even be able to do your own bookkeeping in Excel, meaning much cheaper than having to pay for specialized accounting software or for someone to do the bookkeeping for you. Number 4, it's an accepted accounting method in most countries, also for tax purposes. The rules vary by country, but generally cash accounting can be applied if the business stays below a certain revenue threshold or it doesn't maintain a lot of inventory. So it's a great option for small, simple, and mainly cash-based businesses. An accrual accounting system, on the other hand, is based on when the transaction happens rather than when cash changes hands. In other words, revenue is reported when it's earned, and
The hardest part of understanding accounting is literally the jargon. Literally the jargon, nothing else. And so I feel like once I get past these words, it's like, okay. But I know the Lord is working right now as we speak. So I don't even stress. I can't. I really can't. Because I wanted to cry about 3 separate times when I was in school today. Like 2 times in one class, 3 times in the other. And both times I was looking directly in the face of black men, completely lost.
expenses are recorded when they are incurred. So, for example, if your company sells goods in imported
It's not like y'all see me anymore. Better. So quite weird angle that I'm at right now. You don't really need to see me. You'll just see the back of my head and my long bundles. Maybe I'll stop talking now. I don't ever stop talking.
when it's earned, and expenses are recorded when they...
Alexa, incurred definition.
From Quora.com. The current is the direction of charge carrying electrons. The direction of path.
Alexa, stop. Thank you. Revenue reported when earned, expenses recorded when incurred.
incurred. So, for example, if your company sells goods in January but isn't paid until February, then the revenue isn't recorded until February under the cash accounting method. But it would be reported in January under the accrual accounting method. Let's better understand the difference between cash and accrual accounting, especially because it seems cash accounting is much easier. Why do we even need accrual accounting? Let's try to answer that. Remember Claudio and his Italian beach business? Like any other day, Claudio today goes to his trusted manufacturer of tourist souvenirs to buy his supply of plates. This time, though, the manufacturer tells Claudio that he wants to optimize his processes and he wants to avoid the daily cash transactions. He would like to bring out the cash register only just once per week, and because Claudio has been a great customer for him, he'd be willing to give him credit. So they agreed to settle the purchases for the week, always on Fridays. But for Claudio, this is a great deal because he doesn't have to pay right away. He's working with somebody else's money. This way, he can even expand his souvenir business and buy another item to sell from another manufacturer with his initial 100 euros. In business, we call this the leverage effect. So Claudio decides to go ahead with this idea and invests his 100 euros in another item and buys 50 hats in cash. He pays 2 euros for each hat and plans to sell them for 10 euros to the tourists. Now at the beach, he has 100 plates and 50 hats to sell. His friend, let's call him Mario, comes along and sees the new hats Claudio is selling, and he really likes them. He tells Claudio that he wants to buy 30 hats for this event he's going to in the evening, but he can only pay for them tomorrow after he sold them at the event. Claudio agrees and hands over the 30 hats to Mario. He stays at the beach and sells the rest of his souvenirs and then goes home. He counts the money in his pocket as usual, and it turns out to be 700 euros. He deducts his initial investment of 100 euros that he left the house with, and this gets him to a profit of 600 euros. Is this correct? The answer is, it depends. It depends if Claudio is applying the cash accounting method or accrual accounting. As we've learned, the difference between the two lies in the timing of when sales and purchases are recorded in your accounts. So let's apply cash accounting to create Claudio's income statement. His revenue consists of the 20 hats and 100 plates he sold at the beach. The 30 hats for Mario are not accounted for because he didn't get paid for it yet. Likewise, for his expenses, only the 100 euros for the hats are recorded because the plates he didn't pay for. Basically, this gives us exactly the profit Claudio is calculating by using his usual method of counting the cash in his pocket. And really, this is what it is. Only transactions that have an impact on cash are considered. And we can already see the problem with that. It doesn't provide a complete picture of what happened during the day. In reality, he sold all of his inventory,
Why didn't I think of
but in
this
the
sooner?
income statement, we don't see the full revenue. Another problem is that we show revenue for the 100 plates, but no corresponding cost of the goods sold. In other words, the costs don't follow the revenue, which can present quite a misleading picture of the company's profitability. Now, let's take a look at accrual accounting. With this method, revenue is considered when earned.
I know nothing
What
she
does
said
that
just now
mean exactly?
at the beginning.
This can
Well,
be
I did
quite
understand
a
the beginning,
complicated
but with
topic, but in a
this
bit,
this
which can
diagram
present
here.
quite.
What do you mean? 30 hats for 10 euros each. 20 hats for 10 each, 200. So he paid $0 to Mario, or the other person paid something. I see 0 right there. 20 hats for 10 each, 200, 100 plates. Where does the plates come from? Okay, I guess that's just things that they own 5 each, 500. You get 700. Boom. Expenses, 50 hats for 2 each. That was 100. So you take away 100 plates. For 1 each, you paid $0 at first for the plates. But you had to end up paying $100 for it. So your net profit is 600. Okay, 700 minus 100. That's all I'm knowing.
This picture of the company's profitability. Now, let's take a look at accrual accounting. With this method, revenue is considered when earned. But what does that mean exactly? This can be quite a complicated topic, but in a nutshell, revenue is earned when the products were delivered to the customer or services were provided. And it's reasonable to expect that cash will be received from the customer. The recognition of expenses follows the matching principle, which means that it's reasonable to expect that cash will be received from the customer. The recognition of expenses follows the matching principle, which means that they are recognized in the period in which the related revenue is recognized.
This is literally paying utility bills. Literally.
His revenue will include or recognized in the
I think this is good studying. It really is. Because I needed it. The Lord knows. Expenses recorded in period. The related revenue was recognized.
period in which the related revenue is recognized. Let's see how that looks like for Claudio. His revenue will include all products he sold during the day, meaning also the revenue for the 30 hats he sold to Mario and didn't receive cash for. Why? Because he handed over the hats, he fulfilled his part of the deal. And Claudio doesn't have any reason to expect Mario is not going to pay him. Therefore, Claudio's revenue is 300 euros higher than under the cash accounting. What about his cost? By applying the matching principle, the expenses should be recognized in the same period as the revenues they help to generate. Therefore, we need to report the cost of goods sold
Why is there no
the
title
entire
of these
revenue, which results in COGS of 200. This way, the income statement reports revenue of 1,000 and a net profit of 800 for the day. Quite different than what we would report under cash accounting. In addition, in the balance sheet, we would have to report accounts receivable, the 300 euros Mario still owes Claudio, and accounts payable, the 100 euros Claudio owes the manufacturer of the plates. Both methods have their advantages and disadvantages. The cash accounting method provides an accurate picture of how much cash a business has. It's simple to apply, and since the transactions aren't recorded until the cash is received or paid, the income of the business is not taxed until it's in the bank. On the other hand, it doesn't provide a full picture, and because it doesn't report receivables or payables, it doesn't show outstanding invoices that haven't been paid yet. The accrual method, on the other hand, gives a more accurate picture of the business. If the company has to report GAAP or IFRS, then that's the accepted method. But it means more complex processes in accounting. And its purpose is not to track cash flow. So the key
Alexa, what is GAAP?
Here's how Deardor's Glossary of International Economics defines GAAP, generally accepted accounting principles. Did that answer your question?
Alexa, repeat.
Sorry, there is nothing to repeat.
Alexa, what is GAAP?
According to Wikipedia, goals against average, also known as average goals against, is a statistic used in field hockey, ice hockey, lacrosse.
Alexa, what is GAAP?
Here's how Deardor's Glossary of International Economics defines GAAP, generally accepted accounting principles.
Thank you. Generally accepted accounting principles. That's all you had to say. Alexa, what is IFRS?
According to Wikipedia, International Financial Reporting Standards, commonly called IFRS, are accounting standards issued by the IFRS Foundation and the International Accounting Standards Board.
here is that reported income and cash can be two very different things. Therefore, under accrual accounting, don't just look at the income statement or the balance sheet. Focus on the cash flow statement as well to see if the business is able to generate cash, which is the lifeblood of any business. I hope this video was helpful for you to get familiar with these two accounting methods. If you enjoyed this video, give it a thumbs up, and if you want to improve your skills, consider subscribing.
A little difficult. Unsubscribe. It was cool. You get a like though. It was cool, and then you started. I don't know. I started. Maybe it was me. But just say it was me. Yeah. Now, Introduction to Financial Statements Lecture 2. No more rabbit holes.
Flows under financing activities involve cash.
I'm gonna keep my thoughts to myself, and I'm just gonna learn. It'll film in my back.
With changes in long-term liability and shareholders' equity items, which means under financing activities, we can have cash flow items such as cash from issuing debt and repaying the amount.
Yo, this is like me learning statistics all over again, except it's not statistics. It's real life. Hey.
Amounts borrowed. Cash obtained from stockholders. Cash associated with the repurchasing of shares. And cash used to pay dividends. Now, under cash inflows in the financing activities category, we have examples such as cash from the issuance of common stock. And for XYZ Corporation, we see that it issued 215,000 worth of common stock. We can also have cash inflows such as cash from the issuance of debt instruments such as bonds and notes payable. We can also have cash outflow items and such negative cash flows under financing activities may include repayments of debt issued, repurchases of stock using cash, and dividend payments. Now, note that companies that enjoy relatively stable cash flows can afford higher debt levels because there is some assurance to creditors that future cash flows will be sufficient to cover debt repayments. We will now discuss the articulation of financial statements. Articulation refers to the fact that the four financial statements are linked to each other and that
All pages are filled except for when they started to lose me. He lost me after profit equals revenues minus cost. After that, I was like, ooh. What are we doing here? Hardest part is beginning.
changes in one statement affect the other three. So let's look at some examples of the linkages between financial statements. Now, the cash balance in the statement of cash flows is linked to the cash balance on the balance sheet. Net income reported on the income statement is linked to the statement of retained earnings, which in turn is linked to shareholders' equity and the balance sheets. We will now focus on principles and equity and the balance sheets. We will now focus on principles and assumptions in financial accounting. Let's start off with the full disclosure principle. Under the full disclosure in the balance sheets, we will now focus on principles and assumptions in financial accounting. Let's
we only
start off
focused on it for 2 minutes. How did we do that quick flip, bro?
with the full disclosure principle. Under the full disclosure principle, financial reports should include any information that could affect the decisions of external users. Now, this should be subject to the cost effectiveness constraint, which implies that we should be mindful of the cost as we satisfy the full disclosure principle. Historical cost principle. Now, according to this principle, asset and liability measurements should be based on the amount given or received in the exchange transaction
accountant with the word in question. No problem. Maybe I just went in one and came out the other.
Should be based on the
In the
amount
past,
given
historical means in
or
history. In the
received
past, that's all you have to
in
say,
the
gang.
exchange
Come on, my
transaction,
heart.
which is historical.
You just have to say in the
Note
past.
that the historical cost measurement provides important cash flow information, and it is also highly verifiable. Now to the realization principle. Revenue should be recognized only after the earnings process is virtually complete and there is reasonable certainty of collecting the assets. Now, this indicates that the realization principle applies to revenue recognition. So, revenue should be recognized in the period it is earned, not necessarily in the period in which cash is received. Next is the matching principle, which is an expense recognition principle.
Oh, we did matching.
Under the matching principle, expenses are recognized in the same period as the related revenues. This implies that we match expenses with the related revenues. Next
I wish
is
he wrote the
the
definitions out
going
next to it.
concern assumption, which is in the absence of information to the contrary, it is expected that a company will continue to operate indefinitely. So what this implies is that as we read the auditor's reports that accompany the financial statements of the company, we should be alert for any comments that suggest that there is a doubt that the company will continue to operate as a going concern. Periodicity assumption.
Boy.
And this assumption is that the life of a company can be divided into artificial time periods, and this is necessary to provide timely information to external users.
I was meant to be a YouTuber, not a financial analyst. You're joking. I was meant to be a YouTuber and rapper, not a financial analyst. You're kidding. Is this the behind the scenes of rapper's life? I know NBA Youngboy is not watching YouTube right now, nor Sexy Red. I don't know what they doing, but I know Nikki is not home watching Principles and Assumptions. She's laid up on the zoo, chilling. I'm just kidding. I don't know what they be doing. I'm not speaking on their life in any bad way, but but it basically takes away everything I said before that, and I'm saying something else. What I'm trying to say is, where's my rap check? Because these student loans is not cutting it. Yeah. And don't say that I'm from New York, so I should have connections to this, and that. I was never an eggplant writer. I'm not going to go on the next man or the next female just because I think they lit and I want to get in cahoots with them. That was never me. I'm going to do what I need to do to get to where I need to get. So if it's this and I need to feminine my back and continue, then I have to do that. Don't I hire people for this? To do this stuff? Isn't I going to have it? Hopefully God forbid. I know God will protect my financial statements and my cash flows and my balances, and I won't have to deal with the things that Selena dealt with. God rest and bless her soul. But you serious? Like, are we serious right now? I'm not a complainer. And I'm gonna say but this is just like, why? And I didn't even get to the work yet.
So we
Look at all this time I'm investing. My ROI for the school better be above 87,000. How much I'm investing into this? And let's not forget my political science major that I had. I'm supposed to be a famous rapper by yesterday. Where's the deals and booking agents? Where am I supposed to be? Who am I supposed to be with? I remember I asked Touch for $20. I never heard back from him. What is up? What is up right now? Then, what's his name? I don't remember his name. It was some white boy that wanted me to work for these folks. I don't even remember his name. I don't want to get slapped with any lawsuits for NDAs and not supposed to speak on it. But it's not like I got the position. I was very well qualified. They told me I was overqualified. Overqualified. Overqualified for what? You mean under? If I need to know these information to handle what I handle things pretty well. And we don't go through the full disclosure principles and all of this at once. We do in everyday life, but they're not put in our face for hours and hours talking about like this. Like, break down the task that I need to do and I get it done. That's just how I am. Some would say it's the pink. Wow, that was dizzy. That thing could have went clock. Some could have said it was the Pinot Grigio Colombiano talking, and it's not even all that. I like sweet. Like, it's dry with a little dash of bittersweet, but I could have got this sweeter one. This is like an off-brand, my little cheap wine, an off-brand. What was that other one I had? I don't even remember. It was that orange box I had. Parts of me wants to know. It's called not Prosecco. Was it? No. Lamborghini. Wasn't Moet. Excuse me. Man, I don't remember. Wasn't Prosecco. It was something, and it's clearly not important. I'm done talking and rambling. Maybe I'm just not supposed to be anywhere else right now, but right here. Maybe Mahogany Jules is supposed to be here with 0 people on the live, 1 like, which is probably my mom. Hi, Mom. Thanks for the support. It means a lot. It really does. No sarcasm included. I'm just suffering. And it's not because I have anything against the professor or Tasha didn't respond to me asking for $20 or not funny. Or me not doing what I know I could be doing, which is recording and making music. essentially, I have to do both. See, I've signed a contract, promissory notes that they were talking about on here. So I have no choice. I've signed my life away. I've given away my rights. Meraki Love is non-existent until Mahogany Jewels creates her as an entity. So we're trying to, right now, this is the very, very, very brutal hazing process before we revive Meraki Love, the business entity, diving and oh, we're not going to say jiving because I don't think I even want to know what that means. But no, I do. I know. Is that even a word? Thriving and living. Thriving and living? Perhaps. That's what Meraki Love is going to be doing. I thought of jiving. I thought of gyration. I know that's a disgusting word. That means a rapid movement or circular spinal or whirling motion. That's what I meant by jiving. No, I didn't. I'm just making up things. Okay, let me give my times and minutes back to the system.
At the life of a company to, for example, fiscal year periods, 2013, 2014, 2015, 2016. And for each of these periods, we are able to provide timely information to external users. The monetary unit assumption. Now,
after going concerns, it was periodicity assumption, monetary unit. Might as well create a new flip.
to this assumption, financial statement elements, or the items reported in the financial statements, should be measured in terms of the reporting currency. The economic entity assumption. Now, this assumption is that all economic events can be identified with a particular economic entity. So when we look at the financial statements of a company, we expect that it captures all economic events for that particular company.
I love playback speed being 2.0. Maybe 1.75. Oh, they have 2, but it was just going too slow.
Our final discussion will be on disclosures and notes that accompany the financial
Wait,
statements.
hold on, too bad.
All economic events for that particular company. Our final discussion will be on disclosures and notes that accompany the financial statements. Disclosure notes including a summary of significant accounting policies, description of related party transactions, and notes fashioned to suit the disclosure needs of the reporting enterprise. The summary of significant accounting policies is an important section within the notes that accompany the financial statements. The reason is that the summary of significant accounting policies convey valuable information about the company's choices among various alternative accounting methods. Note that the alternative accounting methods are allowed. So a company chooses among the various alternative methods for one particular account reporting. So for example, a company may either choose a straight line depreciation method or double declining balance depreciation method. We can also talk about the choice of inventory valuation method. So for example, a company.
Yeah, I think I process information much faster. Like, I can't do this, like, I don't know if it's because, like, I'm from New York, or if it's, like, I don't know, I just feel like this is crazy. Like, I really process information, like, on a faster thing. Like, I can't do slow talks. Like, if you really want me to learn, don't just talk mad fast, but, like, I don't know. I really don't know.
May choose the first
That's all I know.
first
Press
to
play.
cost flow assumption when valuing inventory. This is the FIFO method. So we need to know all these, and it is the summary of significant accounting policies that conveys that information. Now, the economic substance of related party transactions should also be disclosed, and the amounts involved in the transactions between a company and individuals and other companies that it has a relation with. Now let's look at the management discussion and analysis section of the disclosures. The management discussion and analysis section provides a biased but informed perspective of a company's operations, liquidity, and capital resources. Note that this section is biased because it is management's perspective. There's also the management's responsibility section, and in this section, there's an assertion by management of their responsibility for the information contained in the financial statements. It also includes an assessment of the company's internal control systems. Now, the internal controls are the systems and policies and procedures that are in place to ensure that the financial statements are fairly reported. Now, the management responsibility section also states the responsibility of the auditors to attest to the fairness of management's financial statements. Finally, there's the auditor's report that provides an independent and professional opinion about the fairness of the representations in the financial statements. It also provides an independent and professional opinion about the effectiveness of the company's internal control over financial reporting. This ends our lesson.
Thank you, Jesus. I don't even want to know about the politics of it. Oh, beautiful. Now we got an ad. Oh, thanks for the other like and thanks for joining. Even though they left.
For your words,
I'm muting that because how dare you freaking give a free promo? That's the only reason I be struggling, because all these ads that be coming through. Evil.
Way of comparing accounting numbers.
Ratio analysis.
Before we discuss liquidity ratios, let's first consider the concept of liquidity. Liquidity refers to...
Didn't you just say before we discuss...
We will discuss ratio analysis in this lesson. Now, ratio analysis is the most common way of comparing accounting numbers. Before we discuss liquidity ratios, let's first consider the concept of liquidity. Liquidity refers to the readiness of assets to be converted into cash.
Thank you. I like this. Can you give me a definition? Liquidity. The concept of liquidity. Are you dead ass? The readiness of the readiness of assets to be converted into cash. Y'all, don't be alarmed. This is gonna be like a huge big burst of like some undiagnosed ADHD stuff. But like literally, I know I mentioned before, maybe it's insecurity or whatever the case may be, but just I know I mentioned before about NBA Youngboy and Sexy Red and what they're doing right now. I'm not saying that they're not hard workers. They work very hard. They just work in the ways that I would prefer working very hard in, like performing and things of that nature, preparation and things. Like I've had my experience, on the stage. I've been doing, the shaking and the thinging and trying to, picture the audience and what it would look like for a performance solely. Very interesting getting there on time and maintaining your real life. Should be difficult. You know what? I'm gonna make this statement. While he's making statements of liquidity, the concepts, the readiness of assets to be converted into cash. See, I'm an asset to my family and I'm ready to be liquid. I'm ready to be converted into cash price. So, there's no limit on how much I am valued. So I'm not auctioning myself because I was already bought at a price by the Lord. So whatever price that is, I'm ready to cash out. I'm ready to cash out. Because no, literally, I want to be by next year, I want to be so locked in. Like, I want to be locked in from now, but by next year at this time, my last year of this program, I want to be so locked in to the extent that, like, so locked in, like, I'm gonna have to choose between finishing school and going up in music, even though I know I'm gonna finish the school, of course, because yeah, I mastered it. Thank you. Own my master's and an actual master's. Yeah. Thank you. Yeah, that's what I want to do. I want all my debts paid off. Like, that's my student loans. I want all of those paid off. And I want to buy my mommy a house in Texas. And I want to buy my old family house in Queens. Those are the things that I want to do and accomplish, and have my own performing arts school, of course. So I know I have to learn these concepts and things of that nature, which is good. But this part is so gruesome. And I think it's really good that I'm filming it because, you know, I said to UNCF I wanted to be an entertainment lawyer, and it's like fulfilling the promises of what I said I was going to do. And I know I said I wanted to do entertainment law. It's like I'm interested, and then parts of me is interested in the financial side. And I said, I'll be an investment banker, I said. And then I looked at investment banking and what I had to do, and I can barely get through these definitions. So I won't be doing investment banking, not even a little bit. Leave that to Mike Ross, thank you very much. But I personally, Mahogany Jules, feels that just learning to be myself and loving myself as I am is the #1 thing that I want to continue to do on this journey of this thing that we call life. I'm looking at this microphone just before me like, you should be here, right here, baby. You should be here, right here. Now, I don't know where you went, but yeah, shout out to Kalani. Love us some Kalani. I mean, I could be getting to it faster, but it's just like, and it's gray. Would you believe, y'all? I've conformed. And I know I said I don't want to conform or I don't have to conform, but inevitably, when you leave one setting and you go to another that is majority something, you conform and you convert. I conformed, of course with God I lack nothing. I conformed and I've converted. Even though it's still pink, I was considering gray. Oh, I would have just completely cried my eyes out. I got a light pink, even though I love the light pink, very cute, very sleek. Nothing's wrong with gray, but I got a light pink. Nothing's wrong with the light pink either. And a light pink I invested into an iPad case with the computer, with the keyboard, which is good. But I felt like my hot pink cheetah and my hot pink cheetah and my Mean Girls burn book iPad cases were a little too, how do I say it, uncalled for this MBA program. I wanted people to take me seriously, and I have hot cherries on my iPad case, and I don't think that would play a role. But then the same as me going in there with hot pink hair, or like, I don't know, just something. And it's like I'm black, so I'm the only black girl. So parts of me is like, okay, I know I'm the shit. Like, I know that. Like, been that bitch. But like, not even a black to it. It's just like what am I preparing myself for right now? Like, what role is this? Like, I'm learning a whole lot, which I'm grateful for. Like, I'd be mad if I wasn't learning anything. And like, you know, some people say feme beco and study, because that's part of me that's saying that. But parts of me has to talk through these things, because it's just not that I'm just gonna sit there and just be like either completely conformed and lost of my thoughts and my emotions and how I really feel, or just that. I don't want to live like that. I don't want to live like that. I feel like I have to express how I feel, because after that hard time of me sitting here studying and not expressing it, then it's like I'd cry. Crying hurts. Crying hurts a lot. I throw some screams in there sometimes. Hurts a lot. Being this amazing person, trying to create an entity out of thin air. Because all of it is in here, because God gave it to me and it's in here. And I see beyond what is present by the open eye. And I feel that. And it's not like I understand it, because I don't want to lead on my own understanding, just the Lord's. But what is it that the Lord wants to do with Mahogany Jules? I'm just the observer, just living in her body. Like, this is the voice, the spirit that's within me, that's talking, and you see this flesh here, it's just flesh. And sometimes it's like, what is the purpose? Like, I'm learning the entities and all kind of things, and it's like, read the word, and I'm reading the word, and it's like, more and more, who is she? I always ask that question, and in that video that I'm going to be reviewing, the 2022 reaction video, my 2025 to my 2022, my 2025 reaction video to my 2022 mindset, it's like, who is she? How do I stay authentic to myself and continue to learn and grow and just be who I am, but go into these spaces where people don't look like me and still stay grounded? And of course it's Jesus, and there's no ifs, ands, or buts about that. I know it's Jesus, and it's just like, wow. God gives you just so much rights of way and passage and authority without you even asking or understanding why. And then sometimes you're just in awe. Like right now I'm in awe. Like it's just like, wow. Thank you, Jesus. Like, wow. Sometimes it's easy to complain, and it's like, I don't forget how far I came. I know how far I came and how far I'm going to continue to go, and I don't ever want it to be for nothing. Like, I see the fruits of the labor. I see it. And this is new labor, new information, new acquisition of understanding. It's good. I wanted this. And it's not to say that I feel alone, because I know there's Jesus. There's my microphone that I really want to do. Yeah, when I have my music, it's like I'm doing music. It's like, it's the ultimate orgasm. But better than that, like, orgasm just earthly and fleshly. Could you believe at a point I was addicted to that? Trying to fulfill something that will never get fulfilled by anything but Jesus. I'm trying to fulfill that emptiness with learning about liquidity, which of course is needed eventually in life. It's just so much, but I need to compliment how far I came. I watched additional videos, and I got transactions part 1 to 3 left after this ratio analysis lecture. And I don't just want to watch it, I want to understand it, and I think that's the number one part to why, or number one part of why I keep pausing the video and stopping, because I can't just watch it and not understand it. I gotta understand what you're talking about, so when you present the numbers to me, it's not just going over my head. And that's what was happening in class, and I wanted to cry this because I didn't watch the videos. So now I'm watching it. Hopefully it puts me at a competitive advantage in class to myself, because that's the only person I'm competing with, regardless of my color. Like, and one of these days I'm gonna back out my Hello Kitty binder, and I'm not gonna care. I feel like me even getting this was just because I wanted to spend money. That's an addiction in itself. But you know, sometimes it's beauty and simplicity, and I would say that was a little tacky. And even when I bought it, it's not like an ugly tacky, but even when I bought it, I only bought it because I didn't want people to perceive me as a mean girl because I had the burn book. But I really like the burn book, not only because it's cute, but it's like when I write my music, it's kind of like it's a burn book. Sometimes, half the time, I'm burning myself. No, that sounds crazy. No, not burning myself. But let's be mature adults here. I just want things. I miss when things were simpler, but when things were simpler, they were also more complicated. But things are very simple right now, but they also get complex. So, but things, it can be argued that things have always been complex. I think that's why I liked philosophy back when I was in high school. I said there could never be a wrong answer because philosophy used to say that what I said is right or wrong. That's why I thought about philosophy. And my philosophy teacher back at Queens College, she was super lit. She reminded me of the lady from the Russian doll. And she had some really big knockers. I was like, I want mine to be just like hers. And here they are. Maybe one day I'll study philosophy as a doctorate degree. But do philosophers even make money? I was like, okay, instead of a JD, let me go and get my DBA, make a quick bag. I don't want to do nothing for a bag. Unless to make music. Because come on, I could do that for free. Come on, I already know. Don't you want to pay the price? Come on, even lonely get better. Why that song that says it gets better, better, better? This is more than life. This is better. That's Jeremiah. It gets better, better. I don't know what song that is. This is more than life. This is paradise. Oh, it's called Paradise. Woke up at home off that Molly. Bad red bone on my body. Smelling like Patron and make gas out. That was one hell of a party. Oh. Well, this is released in 2015 from the album Late Nights. This was the music I consumed. This was my life. Except I don't think I ever taken Molly. But that's enough music analysis. Very beautiful piece of work, by the way. I don't promote drugs, but I will say the instrumentals is absolutely fabulous. It gets better, better. Very beautiful. Very beautiful. And I feel like that connection to where I'm at right now, like, how bad did I really turn out? I don't think I did bad. I think I did pretty good listening to Jeremiah. Would have been better listening to Jesus. But, nobody's perfect. So that expectation of me to be anything better or more than I am right now needs to go. Or anything less also needs to go. There was a point where I wanted to throw it in a bag. I said, I'm just going to go and move to a shelter. And God said no. That sounds crazy. Just a random thought just thrown out there in the middle of my accounting finance class. But I'm a human. I'm a human. The only person I talk to is Jesus. I probably shouldn't be talking to y'all. I only should be talking to Jesus. But I'm human, so if there's any humans that relate to me with all of these pressing thoughts, just don't let it consume you. Don't let it take your time. Because things are going to change. Things are going to get better. This is why I brought up that song. Mine is all the Molly and things of that nature. But yeah, sometimes I just need to sit, remember God, remember my life, and remember my ability to learn new information. That's a blessing in itself. It's okay if it takes time, because it gets better. I don't have anything else left to say. Enough stalling. It's already 9 o'clock. I could have been done watching, but I decided to lecture. I think I like to talk and I like to lecture instead of being lectured. I think that's the number one thing. Just it's hard shutting up sometimes. I'm going to film my back forward this time all the way to this video question analysis lecture, and then from transaction 1 to 3, and then I'm going to warn my mouth, or maybe going to be too tired and go right into how to learn any skills so fast it feels illegal by Justin Song. And after I watch Justin Song, I'm enabling my agenda for the next hour. Then I'm going to go right into the module for module 2 in class assignment and make sure I submit the previous assignment to make sure everything is correct. But it's due Friday, but I need to get the material down. And you see, even after I get this material down, I have to make sure I watch my data analysis videos. I'm losing my Creole Haitian accent. What the hell? I can never lose that one. I never lose that one. It's working just fine.
What this therefore means is liquidity refers to how much cash a company has, how much cash is coming in the door, and how much cash can be raised quickly. Companies must generate cash in order to pay their debts, pay their employees, and provide their shareholders a return on investment. Cash is therefore critical to a company's survival. Liquidity ratios measure the ability of a company to pay its short-term obligations as they become due. Examples of liquidity ratios are current ratio, quick ratio, and working capital. The current ratio, which is calculated by dividing current assets by current liabilities, allows the current ratio, which is calculated by dividing working capital. The current ratio, which is calculated by dividing current ratio, quick ratio. And working capital. The current ratio, which is calculated by dividing current assets by current liabilities. Allows for interfirm comparisons of the ability to pay current obligations. The The quick ratio or asset test ratio is calculated by excluding interfirm. Comparisons of the ability to pay current obligations. The quick ratio or asset test ratio is calculated by excluding inventories and prepaid expenses from current assets before dividing by current liabilities. What this means is quick ratio provides a more stringent indication of a company's ability to pay its current obligations. Net working capital or working capital is a popular measure of a company's to pay its current obligations. Net working capital or capital is a popular measure of a company's ability to satisfy its short-term obligations. It is working capital or working capital is a popular measure of a company's ability to satisfy. discussion on liquidity ratios, it is important to emphasize that while liquidity ratios such as the carriage ratio, quick ratio, and working capital provide a useful indication of liquidity, it will also be helpful to know when the cash flows from current assets will be realized. It is also helpful to know when the current liabilities will need to be paid. This is because an excess of current maturities over the realization of near-term cash will cause a liquidity problem, regardless of the level of the overall liquidity ratio. It is also important to compare the liquidity ratio calculated with the liquidity ratio for firms in that industry. Now, the first solvency and financing ratio we'll consider is the liabilities to equity ratio. This can be referred to as the debt to equity ratio. Now, this ratio indicates the extent
And this makes no sense to me. Like, I know I wasn't supposed to talk, but United States is in debt. The solvency of the US is absolutely insane. It doesn't even meet its own debt obligations. Alexa, what is the US debt?
In 2023, the United States debt accounted for 114.9% of the country's GDP, or roughly $3,184,470 billion.
We are the richest country in America.
of reliance on creditors. Than owners in providing resources. The ratio is calculated by dividing total liabilities by total shareholders' equity. This implies the debt to equity ratio or liabilities to equity ratio indicates the extent of trading on financial leverage. Now,
I'm gonna probably rewatch this back, so I'm gonna talk. This is not sidebars, this is just the reality of things. I know I mentioned it, but like really. He needs to not say this implies. He needs to say this means X, Y, and Z. But that's just me if I was teaching the class, just so people can understand. Like, to say this implies is just a drag.
that financial leverage is the amount of borrowed liabilities. Now, favorable financial leverage means a company is earning a return on borrowed funds.
Thank you for saying means.
That exceeds the cost of borrowing the funds. Now, remember that financial leverage is the amount of borrowed liabilities. Now, favorable financial leverage means a company is earning a return on borrowed funds that exceeds the cost of borrowing the funds. Now, the second solvency and financing ratio we consider is times interest earning ratio. Now, the times interest earning ratio indicates the margin of safety provided to creditors. It is calculated by dividing earnings before interest and taxes by interest expense. Now, earnings before interest and taxes before subtracting interest expense and tax expense. Now we can calculate EBIT, or earnings before interest and taxes, using net income, adding back interest expense, and then adding back tax expense. Note that a low times interest ratio is a cause for concern because that would indicate that the company has a lower ability to pay its debts as they become due. Now, it's also a cause of concern because such a company would have difficulty increasing its borrowing, for example, to expand its operations to take advantage of growth opportunities. Now, conversely, a high times interest earnings ratio implies that a company has a greater ability to pay its debts obligations as they become due. And that also means that there's less solvency concerns for that company. Using the DuPont framework, we are able to analyze the underlying reasons for a company's ROE.
I remember hearing DuPont before. DuPont analysis, okay. I might knock on my neighbor's door. Like, yeah, I need help. Because we go to the same school, and I take the bus and you drive there. And you're doing the same exact coursework, but if you don't help me, Boston Richie said. I hate when the page just takes up so much space and it's all crammed at the corner. This is why I should be using my iPad. But I'm gonna use my book because all my notes are just in one file. I'm gonna be more organized. And next. I mean, it's organized pretty much. I have the dates in the class. I recognize it instantly when I get to it. Anyhow. Average that code is equity, financial leverage, at bound. I think that's what Florida stands for, financial leverage. Choose a different color. Please no, orange. Margin is the amount. Pink is all random. This is literally how I was studying for the LSAT. How would I be able to master an LSAT in this? And I mean, technically, if I really wanted to cram my head and turn myself into a psychologically freaky robot, then I would. I was supposed to stop. Well, while I'm writing these notes down, on the bright side, when I hit 1K, I'm gonna celebrate. Because 1K on YouTube is a lot. It's a lot. With shorts, it's a whole lot easier to like build a following. Oh, I skipped asset turnover. And I know what it is. It's the volume that affects the sales company turnover. Each dollar invested in assets, productivity measure. But I just write financial leverage first. My butt, it hurts. I'm literally doing Pilates all weekend, or maybe in the morning, because I feel so groggy lately. That run into the bus was something serious earlier. There's no doubt I would have been more prepared if I learned this in undergrad. Instead, I was learning terms like what was I learning in undergrad? Just kidding, I know what I've learned. I was doing campaigning and all kind of great stuff in the political world, making differences and things of that nature. Doing the good work of persuasion and understanding our philosophers and being a woman in politics and learning about GDP and all that great stuff. And the brain drain, when you take resources, educated individuals from another country and you bring them to the US. You're draining the brain of that country and making your country richer. The brain drain. Or you're making this country richer, so to speak, or any third world go into a higher scaled country.
Drilling deeper into the ROE and looking at how the profitability, efficiency, and financial leverage ratios influence the calculated ROE. So let's examine the component ratios. The first ratio we'll focus on is the profitability ratio. And under that, we have net profit margin. It is calculated as net income divided by sales. And it indicates how profitable a company is with respect to sales. Note that net profit margin depends on both the gross profit margin and the ability of a firm to control its expenses. Note that reducing operating expenses such as advertising and research expenditures can increase current operating profit at the expense of the long-term competitive position of a firm. Now, such earnings management practices sacrifice long-term benefits for short-term earnings targets. And this is because expenditures on advertising and research often create long-term benefits. Now, let's look at asset turnover. Now, the asset turnover ratio measures the amount of revenue compared with the investment in assets. Generally speaking, we want turnover to be higher rather than lower. Turnover measures productivity, and we can see that an important company objective is to make assets as productive as possible. Because turnover is one of the components of ROE, increasing turnover increases shareholder value. What we can therefore say is that turnover should be viewed as a value driver. Now, average total assets divided by average shareholders' equity measures financial leverage. Now, recall from our prior discussion that favorable financial leverage means earning a return on borrowed funds that exceed the cost of borrowing the funds. This implies increasing leverage increases ROE as long as the assets earn a greater operating return than the cost of the additional debt. Note that financial leverage is also related to risk, so it has an upside and a downside. For example, the risk of potential bankruptcy would increase when financial leverage increases. What this means is that companies must balance the positive effects of financial leverage against their potential negative consequences. So it's for this reason that we do not witness companies being entirely financed with debt. Our final discussion in this lesson will be focused on some of the limitations of ratio analysis. Let's now consider measurability and possible limitations relating to measurability. First, let's note that financial statements reflect what can be. reliably measured. This results in non-recognition of certain assets, often internally developed assets, which are the very assets that are most likely to provide a competitive advantage and create value. Examples are brand name, superior management team, employee skills, and a reliable supply chain. All these items will not be reported in a company's financial statements because they are internally developed assets, and reliable measurement of these assets are an issue. Now, related to the concept of measurability is the expense of costs relating to assets that cannot be identified with enough precision. Examples are brand equity costs from advertising and other promotional activities, and research costs relating to future products. All these items are expensed because it's not possible to identify these assets with enough precision. Now let's turn our attention to historical costs. Many assets and liabilities in the financial statements are recorded at original acquisition or issuance cost. Now, subsequent increases in value and declines in value are very often only recognized if deemed permanent. That implies the asset and liability amounts used in the ratio analysis may not be good indicators of the current market values of these items. Now, that will limit the information conveyed by the ratio that has been calculated, and that will be a limitation. Now, this ends our discussion on ratio analysis.
No, they're not telling us.
Imagine being able to build anything.
Or polynomials. Yes, I'm rubbing the book on my head. I'm trying to get the information in, bro. Maybe if I rub it on my real hair. You just hit the... Well, it's under my Bible. Next is explanations of financial statement effects of transactions. And then part 2 of financial states effects of transactions. And then of course part 3.
Financial accounting concepts. Let me start with the accounting equation. Now, the accounting equation is simply stated as assets equal the liabilities and stockholders' equity. So the assets of a company equal the liabilities, which are borrowing, and shareholders or owners' equity. Remember that the assets are the users of funds. Liabilities and equity are the sources of funds. Now, from the above equation, we can also express liabilities as assets less stockholders' equity. Now, for every transaction, the accounting equation must hold, which means that for every transaction, assets should be equal to liabilities plus stockholders' equity. So if the left-hand side of the accounting equation increases by, let's say, 10, the right-hand side must increase by 10 as a result of the transaction. If the left-hand side does not change, zero change, then the right-hand side should not also change. There should be zero change. So we'll be applying these concepts as we analyze transactions and then as we look at some problems. So let's begin by looking at a plan. Now, on October 2nd, 2011, Starbucks Corporation reported on its Form 10K the following in millions. Now, the Form 10K is the annual report filing for U.S. publicly owned companies. Now, Starbucks reported total assets of 7360.4, total stockholders' equity of 4387.3. Now, the liabilities information provided is total current liabilities.
So assets. So basically, I gotta do some calculations. Transferable skills. So I would do 7360.4 minus, no, asset equals liabilities minus equity. So 2075.8 minus 4387.3 equals negative 2,311.5 million. But isn't it assets equals, no, it's liabilities minus equity. So so it's the reverse. It's not negative, it's positive. So 4387.3 minus 2075.8 2311.5 is D.
2075.8. Now recall that total liabilities has two components: current liabilities and long-term liabilities or non-current liabilities. So in this question, we only provided information about a portion of the liabilities, not all the liabilities. And the question is, what did Starbucks report as total liabilities on October 2nd, 2011? We are asked to determine total liabilities. Now, we need to use the accounting equation to answer this question. And the accounting equation again is assets equals liabilities plus stockholders' equity. So let's look at the question again. Our assets are 7360.4. We do not know our total liabilities, but we know total stockholders' equity. So we can plug it into the accounting equation, and that's what we have. So total liabilities will be the assets minus the equity.
I'm wrong. If I go back here, liabilities equals assets minus stockholders' equity, and they're asking about liabilities. So I would have to do their asset is also a liability. So their total liability 7360.4 minus 4,387.3 73.1.
We do not know our total liabilities, but we know total stockholders' equity. So we can plug it into the accounting equation.
I would say non-current liability.
So total liabilities will be the assets minus the equity. And that's what we also have here. Total liabilities will be assets minus the equity. So if that is the case, we can determine total liabilities to be 2973.1, which is answer C. Now, we are not asked to determine long-term liabilities, but based on the information provided, we were able to determine total liabilities. And from total liabilities, we can determine long-term or non-current liabilities for Starbucks. All we need to do is subtract the current liabilities from the total liabilities, and that will give us the long-term or non-current liabilities. We are not asked that question, so we'll just discuss that just to make sure we understand what to do if that's such a question. So let's look at the second question. Sales for the year equals 108,229. Net income for the year is 13,144. Income from equity investments equal 3309, and average equity during the year is 47,556. We are asked to determine return on equity for the year. Now, return on equity is the overall measure of performance of a company when we look at the shareholder and the shareholders' rate.
Did I write that here somewhere? ROE, net income, is the income of the average stockholders' equity. ROE is the overall measure.
from the perspective of the shareholder, return on equity is the amount of profit for every dollar invested in the company, and be calculated by dividing net income by average shareholders' equity or stockholders' equity. So net income divided by average stockholders' equity.
Net income 13,144 divided by 47. 36. Excuse me. Something's wrong. I got 0.27.6. So what did I do wrong? Oh, I must do 47,556 divided by 13. No, I got another number. So what I did,
Gives us return shareholders. He calculated by dividing net income by average
net income divided by.
shareholders' equity or stockholders.
So 13 divided by 40. 0.276. Nah, something's up. That's a 27.6 here though. Maybe I'm doing the wrong thing. Maybe it's, but when I do this one, I end up wrong.
So net income divided by average stockholders' equity gives us return on equity. And one way to remember the formula for return on equity is to first of all remember that the return, according to the books or in accounting, is a measure of profitability. So we expect to have a measure of profitability like net income in the numerator. Now it is the return on equity, so stockholders' equity. So for every dollar of stockholders' equity, what is the return or what is the profit? So average stockholders' equity is in the denominator. Now to calculate average stockholders' equity, assuming we're not given that information directly, we use the beginning stockholders' equity plus the end of the period stockholders' equity divided by 2. And we do this because the balance sheet from which we get shareholders' equity information reports the balances at the end of each period.
So
for
what's
example,
the closest is
for the year 2015, the shareholders' equity in the balance sheet will be the shareholders' equity balance, for example, on December 31, 2015, that day only. So it is important to rather calculate the average numbers for balance sheet accounts, because the average will represent the average performance or the average measure over the period. So beginning balance plus the end of period balance divided by 2. Now the beginning balance is determined from the previous period's amount. So for example, the beginning balance for 2015 shareholders' equity.
Oh, I didn't even see the beginning balance. Like I'm wearing glasses, but I don't know what it is. Like my brain just skipped over that. I don't know if it's the wine. I don't know if it's the early mornings. I don't know if it's the stress. It's all Satan. Because I didn't see the sales for the year is 108,229. I'm thinking net income is boom. That's crazy. I just skipped over a whole number that was right in front of my face. And that's scary. And I have glasses on. Maybe because I'm not supposed to be wearing glasses this close up. This is for distance. Then my eyes get all boogly woogly. Thank God it's only 10:03. Could have been worse.
will be the ending balance of the previous years or previous. Shareholders' equity. So December 31, 2014 shareholders' equity from 2014 balance sheet will be the beginning balance for 2015. That is, for example, January 1, 2015. Now, in this question, we are given the average directly. So all we do is we use net income and divide it by average equity. And once we do that, we get 27.6%. That is 13,144 divided by 47,556.
What? Gang.
Razor bumps? Get a shave with a touch of aloe. Venus extra.
In this recording, we.
How will you get? Maybe I need to do this backwards. Maybe. That's it. We're just gonna go with what I had.
27.6%. Now we will move on and
Yes,
look
we
at
will.
some
We
transactions.
shall. And
And
we
we'll be using the
must.
financial statement effects template. Let's take a look at the financial statement effects template. Now we have a template of the balance sheet, and recall that the balance sheet mirrors the accounting equation: assets equal liabilities plus shareholders' equity. Now assets over here have been broken down into two components: cash and non-cash assets. Now, we have our liabilities, and then equity also has two components: contributed capital, which we recall is the amounts directly contributed by shareholders, and then earned capital.
I can't
And
write anymore.
the primary component within earned capital is retained earnings. Retained earnings is the profits that have been reinvested in the company. So for each transaction, we expect that the accounting equation must hold assets should be equal to liabilities plus equity. Now recall that retained earnings or earned capital comes from progressively putting back net income as reinvestment into the company. Now recall that there is a link between the income statement and earned capital or retained earnings. And the link is that net income at the end of each period minus any dividends paid is reinvested into the company, and it shows up as retained earnings or earned capital. So let's get started and review the transactions. First transaction: shareholders contribute 15,000 cash to the business in exchange for common stock. Now, to analyze every transaction, the first question we need to answer is, which accounts have been impacted by the transaction? Very often, some of the accounts are stated, so we can pick some clues from the description of the transaction. So over here, cash is involved. Common stock is involved in the transaction. So the next question will be, where do these accounts fit in the financial statements? Cash is an asset. Recall that assets are probable future economic benefits, or simply put, benefits. Common stock is under contributed capital, which is shareholders' equity. So the next question you need to ask yourself is, did the accounting item increase or decrease? Now, shareholders contributed cash, so the company received cash. So cash increased by 15,000. Common stock issued also increased by 15,000, because now common stock has been sold. It is out there. And under contributed capital, we know it's increased by 15,000. Now, as we can see, the left-hand side of the equation has increased by 15,000, right-hand side increased by 15,000. So the accounting equation is balanced. Now, did we have any effects in the income statement? No. There were no revenues or expenses. Nothing was sold. No expenses were incurred. So we have 0, 0, 0. Let's move on to the next transaction. Employees earn 750 in wages that have not been paid at period end. Now, once employees have earned the wages, the company has incurred the expense. However, the expense has not been paid.
Yes, that's
now,
a
remember
liability.
that when an expense is not paid, it becomes an obligation or a liability.
Thank you.
So, liabilities would increase by 750, which is what we have here under liabilities, positive 750. And then expenses will increase by 750. And that's what we have for the second transaction, because employees worked for 750, and that amount was not paid. Now, when expenses increase, net income declines.
I don't
So
like
net income
this
will decline
layout.
by
You gotta
750.
scroll all the way
Your
down to
profits
the bottom
decrease
for
when
the income
expenses
statement. Like,
increase.
what's T?
Now, what it also means is that earned capital, retained earnings, will also reduce by 750. So let's look at that.
Gotta go past
So earned
that.
capital reduces by 750, minus 750, liabilities positive 750, and the accounting equation is balanced. Nothing happened on the left-hand side, so 0, 0. On the right-hand side, positive 750, negative 750,
Okay.
the net effect is 0. Let's now look at transaction number 3. Inventory of 4,500 is purchased on credit. Once again, we can pick the accounts that have been affected by the transaction. First is inventory. Once inventory has been purchased, inventory increased. But the purchase was on credit. So the company owes 4,500 and the account is accounts payable. Now recall that payables are liabilities. So for transaction number 3, inventory, which is a non-cash asset, increases by 4,500. And then accounts payable, a liability, increases by 4,500. And again, the accounting equation is balanced. What happened on the left-hand side, increase of 4,500, also happened on the right-hand side, increase of 4,500. Let's now look at transaction number 4. The inventory purchased in transaction 3 is sold for 6,750. Again, inventory purchased in transaction 3 is sold for 6,750. When there is a sale, we have revenues or sales revenue. So that should show up in the income statement. Now, when there is a sale, we also need to remember that the inventory now goes out of the company. The customer takes the inventory. So we need to subtract the cost of the inventory, which is a non-cash asset. Now, the inventory was sold on credit, meaning that customers or a customer owes the company 6,750. Amounts owed by customers is an asset called account receivable. It's an asset because we expect to receive that amount. So let's look at how these items will be reflected in the financial statements. Now let's start off with the income statement. Under the income statement, we had a sale of 6,750. So revenues, 6,750. Now, cost of goods sold represents the inventory that has been sold, its cost. The cost is 4,500. Recall that the inventory was purchased at 4,500. And recall the matching principle. We match costs or expenses with the revenues that are related to the cost or expense. Now, note that the 4,500 cost of inventory that was sold is what enabled the company to generate revenues of 6,750, which means that the cost is related to this revenue, and that illustrates the matching principle. We match costs and expenses with the related revenues. In some cases, it is a cause and effect relationship. So the net effect of this is that net income would increase by 2,250. If you have sales of 6,750, and the cost of the goods sold is 4,500, you have profit of 2,250. Now this goes to earned capital, 2,250, which is on the right-hand side of the accounting equation. Now let's look at the left-hand side of the accounting equation. Now here, we had credit sales of 6,750, so account receivable increases by 6,750. But inventory, which is also a non-cash asset, reduces by 4,500 because we sold the inventory. So positive 6,750 for account receivable, non-cash asset, negative 4,500 because the inventory is gone. So the net effect is the difference, 2,250, which is at the left-hand side, non-cash asset. So the accounting equation again is balanced. Let's look at transaction number 5. The company collected the 6,750 owed to it from transaction 4. Now in transaction 4, the company sold inventory on credit. So a customer owed the company. The customer paid the company in transaction 5. So cash will increase. Cash asset will increase by 6,750. Non-cash assets, account receivable, will have to decline by 6,750, the same amount. The reason being that the customer has paid. So the customer does not owe anymore. So what is the net effect on the left-hand side, the assets side? Positive 6,750, negative 6,750. The net effect is 0. Right-hand side, nothing happened. Income statement, nothing happened. So the accounting equation is balanced. Let's look at the next transaction. Equipment is purchased for 7,500 cash. Now, a purchase using cash means that cash went out. Negative. So we must reduce cash asset by 7,500. So let's look at that. Negative 7,500 under cash assets. Now, equipment at a value of 7,500 is now owned by the company. So non-cash assets should increase by 7,500 because equipment is an asset, but it's not cash. So it's non-cash assets. And indeed, equipment is a long-term asset or a non-current asset. So here again, the net effect is 0 on the left-hand side. Right-hand side, nothing happened there.
Kinda wanna keep going. Oh, because of course he is.
Red Bull Tandem Roller Coaster is coming to Altamont Springs. Come through and catch all the action on September 27th. Learn more at redbull.com/tandem roller coaster.
You want to take your communication to the next level, whether you're running a business or just starting out, Grammarly has you covered. Grammarly isn't just a spelling or a grammar tool. It's an AI writing partner that works seamlessly with your everyday.
Let's look at transaction number 7. Depreciation of 1,500 is recorded on the equipment from transaction 6. Now remember that depreciation is the allocation of the cost of a long-term asset. For example, property, plant, or equipment would have its cost allocated over the useful life of the asset. For example, you have a vehicle. The vehicle is purchased at 40,000. You estimate the useful life to be 5 years. What it means is that every year it will depreciate by 8,000. Now, based on the matching principle,
Go back.
it means that every year you estimate the useful life to be 5 years. What it means is that every year it will depreciate by 8,000. Now, based on the matching principle, a portion of the cost must be removed from the balance sheet to the income statement as an expense, as you are using it. So every year you use it, you charge an expense of 8,000, and then after 5 years you charge all the expense. So that expense is depreciation. Recall that you remove part of the cost from the balance sheet to the income statement as an expense. So let's see what will happen with this depreciation. 1,500 depreciation. So an expense, depreciation expense, will be recognized in the income statement. So let's go to the income statement. So we have 1,500 right here as an expense under the expense column. 1,500. Now, once expenses increase, profits decline. This articulates is related to earned capital. So earned capital reduces by 1,500, 1,500. Now, the other side of the transaction is that the equipment, which is on the balance sheet, will have its value reduced by 1,500. That is the essence of depreciation. So the equipment's value has reduced by 1,500. So negative 1,500 on the left-hand side, negative 1,500 on the right-hand side. This is under earned capital. This is under non-cash assets. Equipment reduces in value. Let's look at transaction number 8. The supplies account had a 3,800 balance at the beginning of this period. A physical account had
negative 6.
500 non-cash assets. Equipment reduces in 800 balance at the beginning of this period. A physical count at period end shows that 1,200 of supplies are still available. No supplies were purchased during this period. Now, let's look closely at what happened. At the beginning of the period, it's under non-cash assets. Equipment reduces in value. Positive. At the beginning of this period, a physical count at period end shows that 1,200 of supplies are still available. No supplies were purchased during this period. Now, let's look closely at what happened. At the beginning of the period, supplies 3,800 was available. End of the period, we are only left with 1,200 of supplies. What this means is that we used up the difference, which is 3,800 minus 1,200, which is 2,600. Now, supplies is an asset, so the assets declined by 2,600. Now, if we used up that amount, it becomes an expense to the company, and it is supplies expense. So let's look at the effects. An expense should show up in the income statement, right, and under expenses. So we have 2,600 as an expense, reduces net income by the same amount, reduces earned capital by the same amount, and then supplies, which is like inventory, a non-cash asset, reduces by 2,600, non-cash asset, reduces by 2,600. So what we see, the accounting equation is balanced again. Negative 2,600 on the left-hand side, negative 2,600 on the right-hand side. Let's look at transaction number 9. The company paid 15,000 cash toward the principal on a note payable. Also, 750 cash is paid to cover this note's interest expense for the period. All right, let's go step by step. The company paid cash to cover the principal on a note payable. So
negative 50,000.
We know it was a liability, an obligation, a borrowing. So the company borrowed money. It signed a note. A note is a formal agreement to repay the debt. It was a loan. The principal was 15,000, and principal accrues interest, right, on the loan. So the interest was 750. So the company paid the principal, paid it off, and paid the interest also accrued 750. So the total amount paid is actually 15,000 plus 750. But 15,000 will go to principal on the note payable, and then 750 will reduce interest expense. Now remember that interest expense is in the income statement. So let's look at how this transaction will be captured in the financial statements. Let's start off with the cash. Paid 15,750 cash, so we reduce cash by 15,750. Remember the minus sign. Now, the liability is really the principal. The amount borrowed is 15,000. It's been paid off. So minus 15,000. The 750 was interest. And it's an expense in the income statement, which transfers to affect net income by reducing net income by 750. And remember articulation, the relation between income statement and the balance sheet. So earned capital reduces by 750, and the accounting equation is balanced. Negative 15,750 on the left-hand side, and when we combine these two, we get negative 15,750 on the right-hand side. Now let's look at transaction number 10. The company receives 12,000 cash in advance for services to be delivered next period. Now, advance payments implies that the company now has an obligation to provide services worth that amount, and in this case 12,000, in the future. So let's look at the transactions and how it impacts the financial statements. Cash increases by 12,000, and liabilities would increase by 12,000. The specific account under liabilities is unearned revenue. We can also refer to it as deferred revenue. It's a liability. So the accounting equation is balanced. Note that nothing is reported in the income statement. The reason being that the company has not provided the service, so it has not earned any sales or revenues yet. So nothing is recorded in the income statement. So we've reviewed 10 transactions, looked at how they are reflected in the financial statements, and for each of them, the accounting equation was balanced. Assets was equal to liabilities plus equity.
Wix, one platform, any.
Oh, it says wow. Now what is Justin's song talking about?
The fastest and easiest possible way to learn new skills for the last decade. And after years of teaching people and reading the research on this, I've stumbled across a mistake that guarantees an almost 100% failure rate on learning any skill. And sadly, this is a mistake that most people make every single day. I call this mistake theory overload. And I think it is one of the most important things to know about when you're trying to learn any new skill. But first, we have to understand a key, often overlooked ingredient to learning any new skill that allows us to even learn skills in the first place. And this ingredient is experiential cycling. So if I practice shooting this bow every day for a month, I should get better, right?
Oh, before you leave, can you turn that document into a PDF for me? Thanks.
At 5? Maybe.
Bruce Lee said, I fear not the man who did, is it 10,000 or 1,000 kicks in one day? 10,000 kicks once, but I fear the man who did one kick 10,000 times. Okay. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So basically I have to do it every single day to learn, whether if that's maturing my rap skills, whether it's praying and fasting, or whether it's believe it or not, data analysis and accounting.
But maybe not. Once I let go of this arrow, I cannot control where it goes mid-air, at least as far as I know. Where this arrow lands depends on everything that I did in the setup beforehand. And by the way, like any skill, learning to learn is the same. Our exam results, our memory, our depth of understanding, these things depend on the processes we used before when we were studying. Now imagine I shot this arrow and it landed here. Not very good. But to do better next time, I have to know what to change to get it into the center. I cannot keep just firing arrows off randomly expecting to get better. I might get a bullseye once in a while, but it's not going to be consistent, and once the target moves further away, it's not going to work anymore. Same thing in learning. If we get a bad exam result, we need to know what to change. Just because we get a better exam result in a different exam, it doesn't mean we actually solved the problem. So this is essentially the experiential cycle. We have an experience, we observe the result, we think about what we need to change, and then we do an experiment to see if it made it any better. Without this cycle, we cannot learn if it made it any better. Without this cycle, we cannot learn any new skill. This is pretty straightforward and obvious. But here's the part that traps people. Whether it's learning about learning skills or learning to shoot an arrow or learning any other skill, the fastest way to learn any skill
Repetition.
is to learn more slowly. This is the theory overload trap. Now, most of you know that I've got a program that teaches people to learn more efficiently. And one of the things that I can do on the program that I can't do on YouTube is I get to observe how the students behave, and I can track their progress much more closely. So take a look at these two students and see if you can guess which one ended up being more academically successful. First one to look at is this one here, Suresh, who was on the program for 5 weeks and got through 31% of the program. And the second student that I want you to look at is Enzo, who was on the program for 54 weeks and got through 20% of the program. Who do you think improved the fastest? So despite covering less of the course, it was actually Enzo that on it and got through 31% of the program, who was on the program for 54 weeks and got through 20% of the program. Who do you think improved the fastest? So despite covering less of the course, it was actually Enzo who ended up with a better academic result. He went from a baseline of 62% to the latest exam result of 92%, compared to Suresh. And this is the surprising part. Suresh actually went from 80% to 71%. Suresh actually got worse after working on it for 5 weeks. Why did Suresh get worse? I'll give you a clue. It's not just because Enzo had so much more time to work on things. Well, the answer is theory overload. Okay, now imagine this bowl is your brain. Very smooth. Just kidding. Now, your brain has a limited amount of cognitive resources that it can spend. It's like how much memory or RAM your computer has. So let's say that these wooden blocks represent your cognitive resources. Now, whenever we learn a new skill, we're introduced to new things that we need to think about. So each thing takes resources to keep it in mind and think about it. Hold my arrow more tightly. Stabilize my core. Keep my shoulders relaxed. Breathe more slowly. Aim a little bit lower. You can see that my bowl, my capacity is becoming filled up. And on top of that, there's a certain amount of resources it takes to just perform the activity. Now, once a new skill eventually becomes a habit, the amount of resources it takes goes down. But when you're learning a new skill, it's not going to be a habit. It's going to be unfamiliar and difficult and awkward, and all of those things take additional. Each entry represent your cognitive resources. Now, whenever we learn a new skill, we're introduced to new things that we need to think about. So each thing takes resources to keep it in mind and think about it. Hold my arrow more tightly. Stabilize my core. Keep my shoulders relaxed. Breathe more slowly. Aim a little bit lower. You can see that my bowl, my capacity is becoming filled up. And on top of that, there's a certain amount of resources it takes to just perform the activity. Now, once a new skill eventually becomes a habit, the amount of resources it takes goes down. But when you're learning a new skill, it's not going to be a habit, it's going to be unfamiliar and difficult and awkward, and all of those things take additional resources to overcome. So more and more needs to be invested into just doing the actual skill. And as you can see now, we are overflowing. We've overloaded our brain's ability to think about things because we have given it too many things to think about. In the research, our brain trying to think about lots of different things at the same time is called multiple element interactivity, and it's a common reason why we enter into what's called cognitive overload. But here's the thing about learning a cognitive skill, like learning to learn, for example, unlike learning a physical skill like archery. For a physical skill, we burn energy using our body, using our muscles. For a cognitive
Imagine being able to build anything just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea and a drive to bring it to life. Describe what you want and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation where you can go as far as your imagination takes you. Can you imagine it? Let's make your dream a reality right now.
Are you struggling in your calculus class? Do you have a hard time understanding your instructor? Do you wish there was a simpler way? I get it. It's frustrating. You go to class expecting
skill. We burn effort with our brain, which means that the amount of cognitive resources it takes to just perform the skill, the act of learning, is innately very high to begin with. It takes a lot of mental resources to understand new information and process it and organize it and think about where it belongs and create new memory. And all of this effort helps to translate the learning into memory and understanding. If we didn't feel this effort, we wouldn't have any memory, and that would be called passive learning. But with effective, more active learning, it takes a lot of resources to begin with, which means adding just a few more things can put us into overload very quickly. So in that case, what is the best way to learn a new skill, especially a cognitive skill? Well, at the end of the day, all of that means that when we're learning a new skill, we should only ever be trying to experiment with one or two things at the same time. So Suresh, who covered like 30% of the program in a month, would have learned over a dozen new techniques, and each technique has 2 or 3 things to think about. So that means that Suresh would have been trying to juggle 20 or 30 things at any given time. He was completely overloaded, and therefore his brain was not able to actually learn the skill. And this is exactly why some students, if they don't realize this trap, can spend months or even years trying to learn a new skill and feeling like it is impossible to get it right, because no matter how much time they put into it, they do not seem to be improving. It is incredibly frustrating. So here's the secret to learning any skill the right way. Always balance your new theory with practice. If you practice without any theory, it's aimless. If you practice with too much theory, you're getting overloaded. So the trick is to balance new theory coming in with your existing skills becoming habits. Like I mentioned before, when skills become habits, your brain figures out a more efficient way to do it. It doesn't require so many cognitive resources anymore. It finds a shortcut. And so the amount of cognitive resources it takes to perform the skill goes down as more of this new skill just starts to become an old habit. And eventually, what took a lot of concentration to do now takes virtually no thinking at all, and you can still do it just as accurately and just as consistently. We have freed up more cognitive resources to take in some new theory and turn those into habits. For some skills and techniques, it can take weeks, if not months, to develop them into habits. Whereas for some, it can just take a few hours. And by balancing the theory with practice, we can achieve optimum skill growth, where we are practicing, and every time we practice, we are improving with focus and direction, but we're not getting overloaded. So here's what this looks like in practice. Let's say we've only got 5 hours a week to practice. Now that is not probably enough to form new habits very quickly. And so we're going to need to reduce the amount of new theory we take in. And because we've got a low amount of practice and therefore a low amount of theory, the two of them are aligned and we can achieve our optimum skill growth. Now let's say we now have a little bit more free time and we want to dedicate a little bit more time to learning this skill. So we have now 20 hours a week that we can dedicate to practice. So the amount that we can practice has now gone up, which means we can also go up in the amount of theory we can take in. But it's proportional to the amount of extra practice we're getting. So as a rule of thumb, I usually say for every hour of theory, we should have at least 5 hours of practice. So for example, if we have 5 hours of practice, we would only be able to take in 1 hour of theory in this first example, whereas in the second example, we've got 20 hours of practice, therefore we can have up to 4 hours of theory. Now, unfortunately, that's just a rule of thumb. And in reality, it's a little bit more complicated because 5 hours of practicing a very complicated skill is not the same as 5 hours of practicing a very simple skill, like a new way to tie your shoelaces, in which case 5 hours of practice is probably overkill. And so what's more important and accurate than just the number of hours of practice is actually monitoring how quickly we're able to form new habits. When new habits form, we have the mental space to take in more theory. So if we're very slow at forming new habits,
every time I hit a bottleneck, I built a new AI employee to crush it. I used to say that I had one AI employee working for me.
Then we're going to be slower at taking in new theory. And the way you can know that new habits are forming is when you can feel that things are becoming easier and faster without compromising your accuracy and your consistency. And most of the time, you're able to get faster without trying to get faster. The speed comes with the efficiency that your brain develops at just getting better at doing it. Now this is where I have to give props to Enzo, because Enzo realized that he was developing new habits more slowly than we would have anticipated. And so he took a year to cover 20% of the program. So instead of 5 hours of practice for every hour of theory, he was doing more like 15, 20 hours of practice for every hour of theory. So even though on the surface it looked like he was going very slowly, his skill growth was being maintained at an optimal rate because he was never letting himself get overloaded. And by the way, if you're interested in the program yourself, there's a link in the description that you can check out. Now, while theory overload has an almost 100% failure rate, the reverse is also true. Almost 100% of the time, I see someone balancing their theory intake rate with their practice and habit forming rate. They are able to learn their desired skill very smoothly and very quickly, which is why I said that I think this is one of the most important things to understand if you want to learn any skill. I hope that helps, and if you've got the capacity for just one more bit of theory, then check out this video that YouTube thinks you'll like. Thanks for watching, and I'll see you next time. I've coached over 20,000.
No, I don't have the capacity to do one more at this very given moment. I limit myself with all the theories I have taken in. Thank you for joining our think tank. Good night. And God bless America and the rest of the world. Hallelujah. Amen. God is coming soon.